later on, you can. We're talking personal taxation today, so that's what we're going to be focusing on. You do have, let me download this real quick. We'll go do that. You have your quiz that's due by Sunday, and you should be good to go. So right now, this is chapter 4 of the 5 that'll be on your first test. So if you've been going along and doing okay on the quizzes, make sure to write down what you saw, remember what you studied. That's what you're going to be using to study for your test. There'll be 50 questions on that test, and they'll all be from the previous quizzes. So that'll be what you're looking for in the next few weeks, but you still have quiz number 4 today. Get it done by Sunday. You'll be good. In terms of your podcasts, I did get the majority of those graded last evening, so you should have a score on that. Big reasons you wouldn't get a perfect. I had some students write in a font that was like this far apart on everything to try to fill up a page. Didn't get full credit then. Page wasn't that hard. If you get a page, you got it, and you got your 25 basically free points. Any questions? Okay, cool. So personal taxation. This is always fun in this semester because we are actually about the time you would start filing your taxes. How many of you have ever filed taxes before? Glad the guy that's running the sound booth has done it. How many have not? Okay, so I did a class probably 2.5 years ago where we actually went through and we filed taxes in class. It was very boring. I will go through and show you guys the information you need to know. Most of you, unless you're running a small business and get a 1099, have a pretty easy thing to do with filing taxes. Pretty much, it's you get a form of paper, you follow something like TurboTax or Intuit Online, whatever that's going to be. It's going to ask you to find a box and type in a number. And you're going to do that throughout the entire time you're filing taxes. It's going to ask you some questions. You're going to go, yes, no, here's the answer to this. It's really not that difficult. When it gets difficult is when you start having forms that are outside your basic W-2. We'll go through what kind of those forms look like and what I'm talking about here during this lecture. But pretty much it's when you file taxes, you put in numbers and it does some calculations and it tells you how much you either owe or get back from the United States government. So, what are taxes? Taxes are your obligations imposed on individuals by the government, and they also are imposed by businesses or on businesses. Governments use these to build infrastructure. So if you go around, you see a bridge, see a road, odds are they're funded something by taxes. Obviously not all the roads here in Muncie, Pontville Central, but I digress. Social welfare, national defense, other public services, and they're used to encourage economic activity. So sometimes they'll help give some tax breaks to businesses in order to get them to come to a specific area so that it can develop the economy there via jobs and a little bit more spending in that sense. Most working adults will pay the following taxes. There's one you've been paying most of your life, sales tax. Indiana, that's 7%. You go other states, it's going to vary. Each state controls what they get on those that percentage. Other ones are federal and state income taxes. You'll have payroll taxes, and you'll pay a good property tax. Property taxes are based upon where you own a house, and that'll vary based upon municipality or township. So in a given week or given year, I pay all of these. I think the last time I did the total, I think I paid like $10,000 in taxes this year in some capacity. Most of that's taken out before you ever see your paycheck number. But it'll be a weird first paycheck you ever get. Because say you get a $50,000 or $50,000 a year job, okay? Get your first biweekly paycheck. You're thinking, okay, if I divide 50,000 by 26, I'm going to have this amount of money. Then you get your paycheck and it hits your bank and it's like 30% less than what you were expecting. It's because the taxes were taken out before the money hit your bank account. A lot of these are paid through withholdings. So that means the employer takes it out of your pay and you really don't have to mess with it. Why do they do this? Makes it easier for them to collect. So if I told you, I give you guys, everybody owes me $5 right now. it'd be very difficult for me to collect. Some of you may run out that back door. Some of you may come up and pay. Some of you may not have $5 at the time. But it may be a little difficult for me to collect all of that. Now, if I made you all pay $10 to walk in here before you ever sat down, and then I told you I'd give you $5 back, you're going to most likely be able to collect all of that when you walk through. So when you do see your paycheck or a pay stub, you're going to see something called gross pay at the top. This is that amount that if you divided a salary by 26 if you're biweekly, 52 if you're weekly, 13 if you're, or 12 if you're monthly, or if you're doing your hourly, it'd be your hourly rate times the number of hours you worked. That's going to be your gross pay. This includes everything before anything's removed from it. Your withholdings are taken out by the employer. They may be mandated by law to do so, or it could be kind of elected by you. So for instance, if you were putting money into a retirement account, that could be an election you make that is taken out before your pay actually gets paid to you. What gets paid to you is called net pay. That's that number that's actually going to sit in your bank account. Now, payroll taxes. These are going to be mandated by law, and you're going to see them on your pay stub. You're going to see Social Security and Medicare. These are called your FICA taxes, the Federal Insurance Contributions Act. You do pay on Social Security up until you make $128,400 when it was in 2018. Then after that, you don't pay that tax on any additional earnings. Medicare, you're going to pay that on all the money that you earn. When you actually look at this, I believe it's 6.5%, 6.25% that you pay, and your employer pays the other half of it. So I think it ends up being 12.5%. This is important to note. If you're running a small business, you are the employee and the employer. So that means you're responsible for double of that tax. Just a heads up. Here's what a pay stub looks like. Some of you have seen these. A lot of times these are digital nowadays, and a lot of people don't actually take a look at them. I recommend taking a look every 3 months, especially if you've adjusted something. It kind of helps give an idea of everything that's going on with your pay. So, it's going to have your name, and it's going to tell you, a lot of times you're going to see a Social Security number. The Social Security number is called your tax ID. Most of the time, the first 5 numbers are going to be X'd out. The last 4 will be visible. They do this because it tells the federal government who paid taxes. In the federal government's eyes, that ID number gets you your Social Security when you retire, and it tells you who's paid taxes and how much they paid. You're going to see your pay period. Most of the time, you're paid on a bi-weekly pay schedule. That means you're going to have 14 days you're paid for if you're hourly or salary. This is important, though. A lot of times, you don't receive your pay right away. So in this case, you're going to get 1/15. So this was paid the day after it was finished. If you work here at Ball State, you're going to have a week, 2 weeks you work, and then you're going to file payroll, and then you're going to get paid a week after you file payroll. So you'll be on a bi-weekly schedule, but it's actually 2 weeks in the past when you're getting paid. Your employer will dictate how this is paid out. It's important to look at it and go, oh, okay, this is for this period. You're going to see this person got a wage. Their rate was $12 an hour. They worked for 40 hours. They made $480. That would be their gross pay. Then you're going to see over on the right-hand side, FICA, Medicare, FICA, Social Security, Fed tax, and state tax. That total column is going to be what they paid on this paycheck. The right-hand column, the far right column there, is what they're going to be what they paid for the entire year. So year to date. Since this is the first statement of the year, it's going to be the same. The bottom is going to show you the amount of money you made over the entire year, your gross pay. Then it's going to show you your deductions and your net pay. The other bottom side, that right-hand side, is going to show you that for this paycheck. Organization of a pay stub may look different, but basically what it is, it's a register of what you're paying where when you get paid. So if you pull up mine, it's going to have parking pass. It's going to have my HSA on there. It's going to have my dental and vision insurance. It's going to have some life insurance, and it's going to have retirement contribution. My list is quite large. It's going to depend on the elections you have and what you have to pay for your health or your other benefits. So it may look a lot different than this in terms of the number of items on there. Sales tax is pretty easy. You guys have been experiencing this for a while. You pay it on the amount of money that you spend. So when a sale is made, sales tax is accumulated. The easiest way to do this in Indiana, if you want to know what your in total is going to be, you multiply your amount by 1.07. That'll give you your in total. If you multiplied it by 0.07, you'd get your tax right there. Not really that difficult. Like Indiana, we don't pay tax on food. So you'll see something a little different there if you're from out of state. Other states, like if you go up to Indianapolis, that's not another state, but if you go to another city, you may see some additional sales taxes. There was an additional like 1% tax in Indy for a bit to help fund the Red Line, the bus route they were putting through there. So some municipalities, townships, cities may differ a little bit on that sales tax rate. Property taxes. These are taxes based upon the value of an item that you own, most commonly cars or homes. So they vary by state. The word you'll hear a lot is an ad valorem tax. This is according to value, and it's based upon the current value of that property. So for instance, I pay each year when I get my license plates, tax on my car. When I bought my car, I had to pay tax on that. Each year I get a thing in the mail from Henry County, and it's got 2 little payment stubs in it, and I have to pay my property taxes. Some of you who have mortgages, your bank will handle this for you. My situation is strange. They send them to me. I have to send the money in there. A lot of times these are paid through what's called an escrow account if it's on your property taxes. But if it's in your actual taxes for like a car, you're going to have to pay that out of pocket. So you do pay taxes on that. Taxes are quite expensive when you buy like a new car. So make sure you're aware of that. I think my plates on our Durango are like $380. And that's some taxes that we're paying each year when we register that car. So, why is there a need for taxes? Well, you can see where the different things come in, but if you're really looking at why taxes exist, you can hear some people say, I hate taxes, some people will say taxes are a necessary evil. It all comes down to the difference between public and private goods. So it's very easy for me to say that no one else should pay for my lunch if I'm going to be the one who's going to eat it. Okay? It's pretty easy. I can walk into wherever I want to go for lunch today, buy it, and there's no argument that it's for me. Now, how do you do that with like a library or a road? You actually study this when you look in economics a little bit, but those items that can be used by anybody at any time without payment to access, those are public goods. Those goods have to be paid for in some fashion. One of the biggest things you'll notice in all of politics is related to who pays for what. You may say, well, it's really easy. Okay, well, I drive up State Road 3 to get here, so I should pay taxes to help keep that road up. Okay, but how do I gauge everybody that's actually driving on that road? Well, you can see some people put like tolls in place where you're actually paying to use those. But it's hard in a municipality where that State Road 3 crosses Henry County, Delaware County. Some people are taking items to and fro. That's a public good. It's really hard to place that. So what they do is they take that public good, spread the cost of it across the population. So that population may be all the counties that are driving up and down, or through 3 that are all through the state of Indiana. A library may be everybody in that area. Parks are another great example of this. All of those take a little bit of money from everybody, and it helps pay it. That's kind of the idea behind it. Now you could sit here and argue, well, you should pay more taxes. The rich should pay more. The poor pay a lot. I'm not going to get into that in this class. If you like that stuff, go into econ class. You'll find out specifically monetary policy and some of those macro level classes. Those are kind of those explorations into how should taxes actually be assessed. It's a hard question. There are 3 general types of tax systems that are put in place. Number 1's a flat tax. This is going to be everyone pays the same amount. Sales tax. No matter how much money you make, you're going to pay 7% if you're in Indiana. A regressive tax puts a larger percentage basis on people with lower income relative to those of a higher income. Okay, this tends to be in the form of like a total amount that's paid, not a percentage amount. So $1,000 for someone who makes $20,000 is a lot more than $1,000 for someone who makes $200,000. That style of tax would actually put a bigger burden on someone with a lower income. A progressive tax, these taxes, higher income people tend to pay more, a larger share of it than lower income people. Those are the three styles of taxes you tend to see. Now, when it comes to the governments, each government, this is how they make their money. Even though government's a public entity, it does need to make money in order to operate and put the public goods into play. So the government can pull this money in, and they have if they have too much, it's called a federal surplus. If they don't have enough, that's called a federal deficit. U.S. debt money is borrowed and has to be repaid. At the time of this posting, the national debt was over $20 trillion. Now, I took an econ class while I was here. I forget, I think it was monetary, I think it was with Dr. Bohannon. I think he's still here. If you ever want to learn about deficit, surplus, and how all that kind of ties together, take his international economics class. It's kind of enlightening because I sit here and go, okay, whatever on this, now that I have a little bit different perspective than what I did when I first came here to college. So if any of this is interesting to you, go that direction. I could spend hours talking about it and no one would care. This shows you taxes based upon income levels. And then you want to look at where does the federal government get their tax revenue? About 50% of it's going to come from you, an individual tax filer. Another 33% is going to come from you and your employer through your FICA taxes. 9% is going to come from corporate America, and 9% is going to come from other taxes. So if you're a small business owner, you would actually probably be helping in 3 of those categories. I'll skip the question. Okay, so what is a tax return? A tax return is the information that a tax filer compiles and reports to the IRS in a standard form. Why is this required? Because you pay an estimated amount of taxes through a year. Like, you don't have to worry about this with sales tax because it's flat. You know you pay 7%. But when it comes to the rest of your taxes, you're basically paying an estimated amount when your paycheck's coming out. Most people pay too much. Most people pay a little bit too much, and what that does is it creates the need for a refund during tax season. Some people don't pay enough. You can actually, if you were following your income close enough and knew all the tax stuff was there and wanted to take way too much time to figure it out, you could try to get it pretty within range. Most of the time, people are a little high. So you file a form to tell the U.S. government, the Internal Revenue Service, here's what I really should be paying. And that compares to what you paid, and you find out if you should be paying more or less. That's basically the process of filing taxes. Now, it is required if you make income over a certain level. I believe that level is like $1,200, but I'm not exactly sure. That's something you'll need to talk to a tax professional or look up on the IRS website. You may want to file a federal income tax return if you've made just a little bit of money but don't owe any taxes, because there may be a chance that you're owed a refund in some capacity. How does taxes work, or how do taxes work at the federal level? Pretty easy. Start with the gross income. That's going to be the amount of money that you actually made over a given year. So for like right now, I'm getting ready to file my taxes for 2020. You file that by April 15th of the next year. So I'm going to look at everything I made within 2020. Then I'm going to take away some deductions that are allowed for gross income. We're going to talk about those here in the next 2-3 slides. That's going to give me what's called an adjusted gross income. Then I'm going to be able to take some more deductions out. That's going to give me my taxable income. At that taxable income, it's multiplied by your tax rates. We'll show that there's actually a scale of different places you make money at. It's taxed at different levels. Then you're going to get what your assessed tax is. You're going to see if there's any additional penalties or taxes you must pay. Then you subtract any credits or anything that you've already paid, also known as withholdings. And then it's either going to give you a total amount you still owe or a total amount that you need to pay. All the tax forms, all the tax systems are just basically running this kind of math equation. Just a bunch of adding and subtracting and a little bit of multiplying. It's all done on a form that looks like this. Most people don't fill out a form like this anymore. They do it through a computer. Some people still like to do it by hand. If you go to a tax professional, you may get a printout of a filled-in version of this. This is a 1040. This is the standard way that you would file taxes. If you want to go the easy way, a 1040 EZ. They're very clever in the United States government. That's the short form version of a tax return. Okay? You're going to see it ask you a whole bunch of questions. All of these questions, if you go through like TurboTax, they're going to check mark for you. If you go to a tax professional, they're going to ask these for you. It's just basically filling out a form. All that math we were talking about gets placed into those boxes. Now, when it comes to filing, the amount that you get to deduct from your taxes is often tied to your filing status. There are 5 filing statuses, and you'll need to know these for your quiz, that you can have when you're filing U.S. tax returns. Number 1, single. Means you're not married, you don't have any kids that are dependent on you. Okay? Married filing jointly. This means you are married by the magical day of December 31st of that tax year. That'll be a quiz question too, just as an FYI. And you want to file your taxes together. Most married couples tend to do this. It's optional. You can choose to file separately or together. Most file together, or jointly, this is called. Married filing separately is the other way. You have head of household. This is established by you are not married, but you have someone who is dependent upon you, such as a child. And then your last one is surviving spouse with dependents. This is going to be you had a significant other, they passed away, that was actually married to you, and you still have the dependents. You fall under a little bit different category when you're filing. Does that make sense? Any questions? Yes? So the question is there reasons to do jointly or separately? There is. So for instance, give a scenario, me and my wife. Say my wife, she makes bank. She's doing a whole bunch of stuff. She's making a lot of money. I'm a professor. I'm making stuff, but not a whole lot. Me and her may choose to file separately in order to save on taxes. So her taxes, the way the U.S. system is set up, the more you make, the higher tax rate you're going to be paying. If I add my income to hers, we're going to bump our income even higher and have to pay a higher tax rate on it. If we file separately, we still pay the tax rate that was over here, but my money actually falls under a little bit different category. So that would be the reason somebody would do that. There's some other technical reasons. Most people choose to file jointly, but there's some tax benefits depending on the situation where you wouldn't want to file separately. Does that make sense? Okay. Qualifying children. Qualifying children are based upon a list of things. So, number 1, support. This is going to be that the child did not provide for more of half of his own support during the tax year. So imagine, I was trying to get my wife to bring my kid to work today so I could use him in this example. He was supposed to get his shots, like his 1-year shots, and we had to reschedule. but I was going to have her here. I'm going to say, well, he's the child. I was going to let him walk around up here. My child doesn't work. He doesn't make money. I have to support him. He checks that first box. Age-wise, you got to be under the age of 19 and younger than the taxpayer, or a full-time student younger than 24. My kid Daniel, he's 1. See, actually 1 in 1 month. He still follows underneath that. Relationship, it's got to be a child, adopted child, stepchild, or a descendant. Or it could be a sibling, half-sibling, step-sibling, or descendant with them. This is where you become a head of household in some capacities there. So there may be a scenario, you're 20, you have a younger kid, your parents are no longer around, you may be actually the head of household in that scenario. This would actually check those boxes. My kid was my kid. I held him as they did the C-section on my wife. He's mine. I didn't let go. I had to walk him back to the room. And then adobe. This is basically the fancy way of saying, did they live with you for over half the year? Excluding the time they went to school. My kid does. He lives with me. That would check all the boxes. I would have a qualifying child or dependent. So, how do you calculate your taxes? Well, you start with your gross income. We've tossed that word a lot. Then you get to deduct some things that come out of your gross income. Certain things you pay for pre-tax come out while you're doing this. A good example may be your health insurance, retirement savings that are on a pre-tax basis. Your health savings account could also be there. Those are common ones you tend to see. So those are going to be removed from that income. Then you're going to have your taxable income amount. This is before any deductions are taking place from the federal level. This is the amount that you'd have to pay taxes on. Then you get to take your taxes out, or a deduction, either called a standard deduction or an itemized deduction. With the tax bill that went into place 3-4 years ago, 95% of you will take a standard deduction. The amount that's worth went up significantly, and that has actually made it a lot easier for you to select. When you go through filing your taxes, you'll be asked a whole bunch of questions, and it'll go, hey, maybe you should consider itemizing. It's a really easy decision. You select whichever deduction is bigger. If you can itemize enough items to get it bigger than the standard deduction, you itemize. If not, you choose the standard deduction. What the deduction does is it takes that taxable income and reduces it. The deduction is the size of taxes, or the amount of money that you made that you do not have to pay taxes on. So obviously, bigger is better there. You don't have to make the choice. It's kind of a no-brainer, but if you're going to itemize, you need to keep records that can help you figure out exactly what you can and can't take off. Okay, so when it comes to tax rates, the United States have what's called a marginal tax system, also known as tax brackets. What that means is based upon your filing status, you're going to be subject to a tax rate for certain portions of your income. And I wish I had buckets here. The way it works is you take these buckets and you put so much in each bucket, and that bucket's taxed at a certain rate. So if we look at this, the first one is $0 to $9,525. I could put $9,000 and whatever, $25 in this bucket, and that's only going to be taxed at a rate of 10%. Okay? So that's going to be taxed at that rate. Anything I make over that goes into the next bucket. But that bucket can only hold so much money. That bucket itself is going to be taxed at 12%. Okay? If I still have leftover money, it goes to the next bucket. That bucket can only hold so much as well. Anything that's in that bucket is going to be taxed at a 22% rate. You're going to add up how much taxes you have, and that's going to tell you how much you're going to pay. So the more money you make, farther down buckets you get, the more you're going to have to pay on that money. So why deductions are helpful, because it helps reduce the amount of money you got to place in the buckets in the first place. Does that kind of make sense? Your filing status helps determine how big your buckets are. So if you're single, those are going to be your buckets. So you can have 9,000, 38, 82, 157, 200, and half a mil. It's going to be your range. If you're married, you're going to see everything magically doubles. Why? 2 people. You get to put your buckets together. So your buckets get a little bit larger, and you pay a little bit different on taxes. So you look real quick, me and the wife, as long as we stay under 165,000, we're not going to have to really worry about anything more than a 12% tax rate, 22% tax rate. If it was up here, that would be a 24% tax rate. Okay? How does this play out? So you can see if you were filing married to single, if you both made the same amount of money, those who are married pay less than those who are single. Not to encourage marriage. Okay, this is not the talk there. The reason this happens is if you had 2 people and they were filing taxes separately, one would pay money, one wouldn't, they would actually net out about the same. Just shows it in a comparison of one individual compared to 2. There are some tax benefits to being married. So as you go through your life, if you decide to get married, this should never be the one reason you get married. Okay? You shouldn't go, oh yes, I love your hair, and I really need to get my tax rate down. That's not a reason you should really be going after it. Just something to know that when you get married, it does change things a little bit. Marginal tax rate, what this is, basically, we're in our buckets. The marginal tax rate is going to tell us the average tax rate that we pay across all of our buckets. So I had a 10, a 12, and a 22. If you actually figure out what that amount was that I paid in taxes, spread that out across it, I'm going to have a marginal tax rate. It's going to tell me what I paid on that last dollar. There's another way taxes are assessed. Capital assets. We mentioned this in the last class, but the tax rate that we were talking about earlier only falls to ordinary income. So that's your income from work, self-employment, retirement plans, rents, royalties, and other sources of earned income. Capital gains is included in gross income, but it's applied at a different tax rate. Okay, so if you're selling something that you've held for over a year, that will be taxed at a different rate than if you were just making money from your job. I think that rate's 15% for a specific amount. So there may be some times you want to hold things, keep them. You don't want to sell them because your tax rates, that makes it lower. When I sold my business, I had to pay capital gains tax on it. So I had to set the money aside and pay that out of pocket. Okay. There is a stark difference, and we're going to show a slide here between a deduction and a credit. Deductions take away the amount of taxable income that you have. In essence, it reduces the amount of tax you pay, but only by a percentage. Credits are a dollar-for-dollar reduction in your tax burden. So when we go back to our bucket scenario, a deduction is going to limit the amount of money I have to fill up my buckets. A credit is going to take, after I figured out how much taxes I owe outside of the buckets, it's going to remove money from that amount. A tax credit is more valuable for a taxpayer than a tax deduction. That will be a quiz question. That's the question that comes through like in a few of the chapters. Know that. Tax credits are more valuable than deductions. Sometimes these are refundable, sometimes these are not. Just depends on the situation. Let's give some. The most common ones are low-income working households with dependent children or college students. We'll talk about some of the credits here in a bit. This shows you an actual mathematical example of why a credit is a little bit more valuable. So this could be the same, these are the same people. The left-hand column is if they had a $1,000 deduction. The right-hand column is if they had a $1,000 credit. You're going to see that the deduction lowers the amount of taxable income by $1,000. So that's that 7,000 and 8,000 range. Then you get to the amount of tax owed. You see it lowered it by $100 on the left-hand column compared to the right-hand column. The credit comes in after that. So they actually had a savings of $900 difference on a $1,000 tax credit. So tax credits are more valuable. Here's the deal. You can't actively go find tax credits. There's a few things you can check your box on. But if you get a credit, just know it's more valuable. It's going to give you a little more money at the end. I'm very excited this year because this is my first year of filing taxes with a child. Child's a tax credit. They give you a deduction and a credit. I'll be interested to see how much money I get back for my taxes for the next 18 years. I bet it still doesn't cover diapers though. Refundable, those can be paid out. So that means if you owe any taxes, it'll take you down to 0, and then it'll be paid out to you, anything that is still owed to you. Non-refundable can just take you down to 0 on the taxes that you're owed. So there are a few different types of tax credits. You have education tax credits. That's going to be your American Opportunity and Lifetime Learning. We'll explain those in a sec. There's child-based tax credits. There's health insurance tax credits. And there's retirement savings tax credits. So, education. There's 2. You cannot have both of them at the same time. You can have one or the other. One can be filed by you or your parents, specifically parents. One can be filed to you if you continue college or you're paying for college on your own. The American Opportunity Credit is, this is a partial refundable tax credit available for those who claim a student as a dependent on their tax returns. It's going to be for your parents. They should be getting this if they're helping you pay for college, or if they're filing with your taxes, you own their taxes. This may be valuable to them. You may want to have a talk with them about that as well. It may help fund some of your stuff. Lifetime Learning Credit is available for anyone else who's taking college classes that does not qualify for the American Opportunity Credit. There's a question that's commonly asked in this class during this session. Do I file by myself or do I file with my parents? There are some very good discussions to have around that. But what I would do is I would talk with your parents, get your tax forms. Odds are they're going to save a little bit more money having you file your taxes than you would get back. So for 95% of you, probably file with your parents. But a good way to check is to run numbers. Like, let's say you're using a TurboTax. You don't have to pay to start using it. You can get to the very end and just don't file. So you can run through the process and put all of your stuff in and see what you would get back or you have to pay. Then have your parents run it through with you and without you. Whichever one gets you the most money back, that's the one I would do. Okay? That's a good way to do it. Or talk with a tax professional and they're going to give you that answer. There is an income limit on how much you can make before you have to file on your own. But odds are, unless you're working a full-time job, like 40 hours a week, you're not going to hit that limit. So you'll have those options between those two. Yes? Yeah, so the statement that was made was basically with the stimulus checks that were issued this year, there's some other complications that go through whether you should file on your own or file as a dependent. I do not know enough about that to make an educated statement here in class with it. I don't want to point you guys in the wrong direction. I assume what you said is true, but I do not know for sure, so I do not want to push that out there. That's a talk you need to have with a tax professional. Like for instance, we have a kid, and we never got any of the tax payments or the stimulus checks for our kid. I know that I have to go back and file with him, and I can actually redeem that credit and get those payments out. So he's extra valuable issue too. But also when you talk to your parents, if you didn't receive a tax credit, you may be, or a stimulus check, you may be entitled to that depending on how you file. Okay? So I do not have the exact information there. that's a good question to ask. I appreciate that. Tax credits for dependent children. So earned income credits, refundable, designed to reward work and boost the earnings of low-income workers. And the child tax credit. This gives you a maximum non-refundable credit per child of $2,000 and a refundable credit per child of $1,400. So that's why I'm excited, because my kids were something to me. No, I'm just kidding. That's a joke. It's not meant to be that. Do not have kids for tax credits. Okay, that is not a good practice either. Don't get married for taxes. Do not have children for taxes. If you are paying for your health insurance specifically through the healthcare marketplace, you may be eligible for a premium tax credit or an advanced premium tax credit. This helps subsidize the cost of that health insurance for you. And then retirement savings contributions. If your income is below a certain amount and you paid money towards retirement, you may be incentivized through a credit from the government to actually incentivize you to invest. We're getting close on time here. I think I still got like 20 slides. So I'm going to speed through these. If you get a 1099, that means it's a form. That means you are an independent contractor. Also means somebody told the government that you got paid money, so they expect your taxes. That means you're self-employed for that day. Self-employed people have to pay taxes that weren't taken out of their other income. That being said, always save back 30% of the money you earn from something in a savings account. Why did I say this? Right out of college, I had been, your random story of the day, I sold a bunch of stuff on Amazon. I'd go to a store, I'd scan it, find something you could resell at value, sold a bunch of this. Amazon sent me the money, I really didn't think much of it. Fine. Go to file my taxes that next year. I owed $15,000 in taxes, which was a very nice surprise for someone who had no idea that I was supposed to be paying anything. It's there. If you get money that you earn, always set 30% back. It's great for you because you know what? If you have to pay that, you pay to the government, you have money there, 30% is more than enough. You just don't want to be like your stupid professor that did that right out of college. So that's just my word of wisdom. If you make money on the side, before you spend any of it, set 30% back. That's in a savings account. I labeled mine tax escrow in my Chase Bank. And now every time I make money, 30% goes away. Then I spend or pay or do whatever with the rest of it. If you have a 1099, you have to file a little differently in your taxes. This is where I recommend either doing it with somebody who knows what they're doing or go to a tax professional. I file with a guy in Newcastle, Wadman Accounting. He charges me $100. That's it. Get my taxes done, I don't have to worry about it. I have a folder. It's in my bag here. It's labeled 2020 taxes. Let's see if I can find it. My wonderful 2020 tax folder. I'm just throwing stuff on the ground. It's got everything I need in here, plus some other things I still have to put in there. But this is what I hand him. We sit there, it takes about an hour. Magically, my taxes are filed. Don't know why I carry that in my backpack, but you know. It gives you some examples of what a 1099 looks like. So this person made 20 grand. They would be responsible for paying taxes on that. Now they get to remove some other benefits, such as their cost of goods that were sold, professional services, advertising. If you're running that business, save receipts. I have an app on my phone called Shoeboxed. Anything that is tied to my businesses that I do on the side, I take a picture of the receipt and I process those by putting in a title and how much, a date, and also a category. This gives me ease of access that when I'm ready to do my taxes, I simply pull up the Shoebox site, I write down exactly what the numbers say there, and I go about my business. Okay, lowering your tax rate. There are ways you can lower your taxes, but odds are most of you aren't really going to have to do this. This may come into play when you get to retirement age, though. So, my piece of advice, remember that when you get close to retirement age, talk to a financial advisor or a tax professional and ask them what you can do to help reduce that tax burden. It's the best piece of advice I give you, because my guess is you guys won't remember what I said 40 years from now, if I gave you specific directions at this point. There are tax-exempt incomes, 529, Roth IRAs, primary homes, and health savings accounts. If you're looking for things you need to save back, common deductions you can take on your taxes, tuition and fees paid, price of books or course supplies, other required expenses for school, student loan interest. If you get a form for those or have receipts, take those to your tax professional. Health-related expenses. If you're an unhealthy person, or you have to go get treatments or this or that, save your receipts. You may be able to take those off in addition to your standard deduction. If you're self-employed, track your mileage, track your food, track your stays, track your stuff you purchase. Anything that makes that business go may be eligible to be deducted on your taxes. That is it. You have a quiz due on Sunday for quiz number 4. I will see you here in person next week for... No, I won't. That's a lie. Next week, I will not see you. It's a study day. So you do not come to class. I will not be here. Neither will you. Take the day off. Enjoy it. We'll do chapter 5 when we return. And have a good break. I'll see you guys in 2 weeks.